Well, good evening all. What we're having a look at over the course of the next couple of hours, we could be having a little look at bookkeeping, practical bookkeeping, because you're going to have to keep your books. And this is the element I find that a lot of people find the most intimidating. Oh my God, it's my figures. But actually, it's probably one of the most simple elements of it. There's a basic fundamental rule to business. I know you are setting up social enterprises, but they are still businesses. Money in, money out, what's left? Basically, anybody doing an accountancy degree here? Now, that's basically what accountancy is. Money in, money out, what's left. If you can get those three things right, then you're going to be on a pretty good even keel. So we're going to have a look about bookkeeping, and I will demonstrate Michael's two-shoebox method of accounting this evening, just to illustrate how simple it is, not a recommendation as how you should actually keep your books, I hasten to add. And then we are going to spend some time on this little puppy here, cash flow. Cash flow is, without a doubt, the single most important document your business will ever have. 80% of businesses fail because they run out of cash. And I'll give you some examples of that when we get to it, but this is the absolute most pivotally important part of your business. I say lots of things are important in your business, but what you've got when you're planning your business, now we talked about all the research last week. Basically, when you do your business plan, which I'm sure all of you are doing, yeah? And there's lots of important things in the business plan, and the business plan is essentially a big old funnel. There's your business plan there. And you shove stuff in the top of the funnel. You know, your decision to be a charity versus a social enterprise, which suppliers you use, which equipment you use, your locations, etc. All of that information goes through that funnel and comes out in one place, and that's called the cash flow. Every single decision you'll make is going to have a positive or negative effect on the cash flow. So yes, there's lots of important decisions to make as you're setting up your business. But the most important document you will ever own is that cash flow, because it will indicate whether the venture is actually worth doing. Because even as a social enterprise, you have to be able to at least break even. You really want to be able to turn a profit so you can reinvest into future projects. So we'll have a good old look at that. And I'm sure it's something that you will have to get involved with at some point if you haven't already. Then on the back of that, we'll talk about raising finance, places you might be able to go to get a little bit of cash, which again you're going to have to think about in the startup of your businesses. And then I won't do a heavy session on this, because it's really not the kind of thing you do approaching 7 o'clock on a Wednesday evening. But we will have a little chat about tax and VAT just to get head around those. And what I want to talk to you very lastly is social currency, because you are going to be generating, hopefully, revenue in terms of money from funding from whatever enterprise you're in, but you are entering into a social contract with people. So we'll have a little look about your social currency as well. And I'll illustrate the way WENTA approaches this, I say, towards the end of the session today. Let's start off with assessment. 2 weeks ago, I came and provided you with this. Now actually, research is the thing that kind of builds the foundation of your business. Now the more you know, the better your decisions, the more successful your business is likely to be. So that research is very important, particularly as far as the financial element is concerned. So what's the current cash position? Your current cash position could well be zero. Actually, it could even be negative. A lot of businesses start with negative equity, and we'll have a look at that cash flow later on. Startup costs. Startup costs are the things you have to buy before you can even think about trading. So insurances, DBS, because I remember you from last time you were working with NEETs, aren't you, in particular. Equipment, transport, all the things that you have to buy before you can even think about trading. Stuff you've already got, ignore that, or have a note of it. We'll come back to that later on because it's quite useful. This is the stuff you have to get, not the nice to haves, but the need to haves. So you find out what the startup costs are, because then you've got a figure that you have to work with. Because if your startup costs are £1,000, you then have to find from somewhere £1,000, because businesses cannot start in the red. Red numbers have to be addressed. Then you're looking at the running costs, which is where a cash flow comes in very useful. The running costs are rent, rates, petrol, equipment, stationery, all of the kinds of things you're going to be paying to keep this thing going as well. So you need to find out what they are, because ultimately you have to be able to generate more income than the running costs. Because if your business costs you £1,000, a month to run, you need to generate £1,001 at the very minimum to make sure that you've got something that is worth pursuing. And we'll cover that far more in the cash flow when we get to it. And also funding. Where are you going to get the money from? And we'll talk about some of the places you can go, I say later on, and also what they will require of you before they even think about giving you any cash. And that's the thing. People who give you money don't always care particularly about the social purpose. Particularly if you go into official bodies like funding agencies, banks, etc. They really care about whether you have the capacity to pay it back, regardless of social purpose. I worked in a bank for 12 months, or for a banking company for 12 months. Not the most happy year of my life, must be said, but it gave me a very keen insight into the fact that actually banks, much as they are maligned as people who make too much money, and also causing an economic clash, because I was actually working for a bank in 2008, and that's why I spent a year unemployed in 2009. Thanks, bank. However, I am from a corporate management background. I worked in the corporate world, in the banking industry, all the way through to customer services and all of that kind of thing, retail. And you've got to make more money than you spend, because if you don't, you can't. You know, for a business, you can't employ anyone. If you don't make a profit, how do you pay wages? How do you pay rent? Same with you guys. If you're not making enough money, how on earth are you going to be able to look after the people you want to be able to look after? Now, I work for a social enterprise. We have a very keen sense of what our social purpose is. I say I'm going to give you a model of that later on. But we still have to turn a profit. As soon as we start losing money, we are unable to help the people who do so desperately need our help. So although we are very focused on our social purpose, we do also have to be incredibly focused on our cash position as well. And it might not be it's certainly not what you guys have got into this for. And it's not what WENTA started up 32 years ago for. Loads of people were made redundant through British Leyland, I think it was. And a load of guys, businessmen, said, God, we've got all these guys who have been made redundant. Why don't we just help them become self-employed? And that's how WENTA started, with that social purpose. And now it's grown into a place that has 4 massive business centres, employs 100 staff, and starts up 100 businesses a month with an 87% success rate after 12 months. Now, all of that kind of stuff is brilliant, and I must say we've had a contract from the Job Centre which sorted us out financially for a very long time. But the bottom line of what we're doing is to make sure that people who can't work can, through whatever means possible. But it's got to be driven by financial considerations, otherwise we cannot help anyone. Okay. So let's have a little talk about your limited company, because if you set up a social enterprise, a community interest company is essentially a form of limited company. You have to register it with Companies House and you will pay tax as a result of that. Has anybody incorporated their social enterprise yet? So that's your first cost, ladies and gentlemen. You need to find around about £36. It's generally between £18 and £45 to set up a limited company, whichever nature you do it. So that's your first start-up cost, because you can't be a social enterprise unless you actually register as one. And if you're wanting to have social purpose, it is always a good idea to be a social enterprise or a charity, because then the potential funders will take you more seriously. It's far more difficult to get money as a limited company or as a sole trader for this kind of enterprise, because social enterprises, they're not allowed to run off into the sunset with the profit that they make. There is a certain thing they have to do. There's an ombudsman. So it's a 10-page online document to set up your limited company. At the end of every financial year, you are required to submit these to Companies House. Director's report, accountant's report, profit and loss, balance sheet, notes. It is a legal requirement for you to get those on Companies House website within 9 months of your year end. Now, the year end is whenever you decide your financial year runs from. Most people run their financial year to match the tax year, April to March. That means they just all do all their books in one big blob. Doesn't work for every company. WENTA, for instance, we can't run our books from April to March. Problem we've got is that if we run our books April to March, in around about January, February time, we have to do all our budgets. So we have to figure out what money we've got to spend for the rest of the 12 months. Now, the problem is a lot of our funding is government funding, and the government don't get their funding until April, and they generally take at least 3 months to figure out how they want to spend it. So if we try to do any kind of budgeting in January or February, we're doing it with numbers that we're inventing. because we don't know how much money we got. So about 3 or 4 years ago, we shifted our year end to run from September to August, because by September we know all of the budget and the money we've got to spend, and we can make sensible budgeting plans going forward. Which means for us, we have 9 months from August to submit these 5 to Companies House website. As a small company, you are allowed to submit these yourself, certainly in your early stages. However, I would strongly suggest that when you do get to the point where you submit those documents, that you get someone professional to overlook them, because the fines for doing it wrong are not small. We're talking multiple hundreds, not a couple of quid. What that means is that your books are online. Anybody can pay £1, go onto Companies House and look at your records. But similarly, if you have any competitors out there, you can pay £1, go on to Companies House and look at all of their books, which is really quite cool. It's a good research point. So there is a cost potentially inherent in there, because even if you do them yourselves, certainly the first time you submit them, it would be worth the cost of paying an accountant to give them once over, because you don't want to get that kind of thing wrong. Large companies, 250 employees, 2.5 million turnover. Anybody going to get there just yet? Don't worry, you won't be audited then. Bookkeeping and accounts. Now you guys are probably going to have to do this yourself in the early stages, and keeping good books is really important. Why keep good books?
So you don't forget stuff.
So you don't forget stuff. That's a good enough explanation for me. So you don't forget. Yeah. What else? You can improve stuff. I like the stuff coming out here. Yeah, improvements. What else?
Improve or improve?
Not.
Demonstrate. Prove.
Demonstrate, prove. We can improve, let's prove. Right, okay, yeah. Sorry, my handwriting and my spelling are awful. I'm left-handed and dyslexic. Double whammy. What else?
Check that it's running profitably.
Profit, yes. The key word there is viable. Is it viable? Yeah, what else?
Tax.
Thank you. I actually like the fact that that's come out quite far down, and I'll explain why in a moment. Okay, what else? Because there is a massive long list of stuff.
Modelling capacity.
Yep. So you know how much you can do. Oh gosh, deity, you know what that says. Modelling capacity, because you need to know how much you can actually do, because actually there are an awful lot of businesses that fail because they grow too quickly or have too much stuff to do, just as much as ones don't get enough. So yeah, make sure what is the capacity, how much can I actually do? Lovely, because there's only one of you and there's millions of people out there to help. What else? Anybody going to be having to use suppliers for anything? Goods, services, etc. I'd imagine so, yeah? You've got to check your suppliers, keep a record of them, find out the ones that are actually the ones that are giving you the best deal, because you want to reduce costs to increase profit as much as possible. So this is the lifeblood of your business. This thing here is actually, in my view, probably one of the least important. Because if you keep excellent books, if you record the money that comes into the business, the money goes out of the business, and what's left, if you've got those figures recorded accurately, you will never have a problem with the HMRC. Because they ask you to keep sufficient and accurate records, and if you do an online tax return, you have a box that says what your turnover is, that's all the money you've earned. And let's face it, if you don't know that figure, what the merry heck are you in business for in the first place? And there is another box that asks for your business costs. And if your business costs are less than £10,000, you can do a lump sum. If they're more than £10,000, you have to categorise them into 10 areas. They ask for that figure and that figure. You press a button and they tell you how much tax you owe. So provided you can demonstrate accurately to the HMRC the money that has come into the business and the money that has gone out of the business, they are absolutely happy with that. They take it on trust. You don't have to supply your books every year for your tax return, but just bear in mind that the tax office do have a little thing called the lottery no one wants to win. This is an HMRC term for when they get a load of businesses, they stick their hand in a barrel, take out a business and go, we'll check that one out today. They also keep a very close computer check of groups of businesses. So for instance, if you're a hairdresser and you submit your returns, they will compare your returns to similar hairdressers, and if there are any anomalies, they'll go, right, we'll have a chat with them. And the HMRC have a bad rep. People don't like the tax man. but actually the HMRC are incredibly engaged with small enterprises these days. They have had a complete turnaround in the last 10 years to their attitudes. They want to help you as much as they can. So they are an ally, and please, as much as possible, engage with the HMRC. They've got online seminars. If any of you are going to have to run a payroll system, which some of you might do, you can download a free payroll system from the HMRC website once you've engaged with one of their training areas, I believe. They can run 5 businesses and up to 50 employees, and it is a real-time payroll system. The HMRC want to help you get it right, so please have them as a favourite on your browser and engage with them. They've even got a contact centre where people are desperate to talk to you. I worked in the contact centre industry for 15 years. Generally you sit there looking at the phone going, please don't ring, please don't ring, please don't ring, because you're fed up with talking to people who don't appreciate you. The HMRC pick up the phone and go, hello, because no one ever wants to phone them. When someone does, they're so delighted, they just help you out. And I'm serious. I mean, people have often said on courses that they bung in you a little bit of a backhander to promote them, and it isn't the case at all. I work quite closely with members of the HMRC through a scheme we did 3 or 4 years ago, and seriously, they are fantastic. And there is even an HMRC-endorsed tax avoidance system, which I will talk to you about later on. Funny that that's been in the news recently. Vanilla tax avoidance. Compared to what? Chunky Monkey? I don't get that whole thing. But it is a vanilla HMRC-endorsed tax avoidance scheme for directors of limited companies, which you guys are going to become. It's quite awesome, really. Might work slightly differently for social enterprises, but I'll tell you about it anyway. So why keep good books? Very simply, because you're required to and your business needs you to. So purpose is to determine the success and financial health of a business. It is the basis for paying tax, and the bookkeeping needs to be set out in a manner that both you and the taxman can understand. So you've got to be able to produce your books in a manner that if you give them to someone else, they can look at them and go, I get that straight away. And how you do that is entirely up to you. If you want to have a Sage package program to keep all of that, which is what the accountants use, you can do that. If you want to have QuickBooks, which is a lower cost alternative, which is very good. Microsoft Money does a reasonable job. A spreadsheet on Excel, and 2 shoe boxes and an A4 pad, which I'm going to go through with you in a minute, will do just as well. All you need to do is demonstrate to Her Majesty's Revenue and Customs that accurately the money that's gone in, accurately the money that's gone out, because you will pay tax on what's left. And that's all they really care about. They don't want a penny more or a penny less than they are owed. If you overpay them, they will give it back to you. I think it's a 3-week turnaround. If you don't pay them enough, bear in mind that your records go back 6 years and the HMRC charge a daily rate of interest. So if you made a mistake 6 years ago, you will be asked to pay that and 6 years worth of daily interest, which is quite a lot. So do try and keep your books properly, and if you can't keep your books properly, find someone who can. And cash is everything. One of the first things our chief executive said, we have staff meetings once every 4 months, 3 times a year. Half of WENTA go on one day, half of WENTA go on the other day. We eat an awful lot of cake and chat. But the first thing that our chief exec always talks to us is about our cash position. What is our cash cushion? What have we got in the bank that we can survive on if all the funding goes? And for instance, one of our biggest funders over the last 3 years has withdrawn recently. It's just the end of a contract. Can't be helped. We've had to let a load of our self-employed trainers go, but we've still got a surplus, which means that to an extent we can continue to offer the free advice that we're able to do to people who want to be self-employed, because we've got this nice surplus of cash that's built up through our more commercial elements of our business. What needs to be recorded? Everything. Everything. And there are no exceptions to this, because you have to evidence it not only for your purposes but also if the taxman ever decides to knock on your door. So every penny that you receive and you pay needs to be evidenced, written down, documented. All of your pre-trade expenses, so the things that you have paid for before you've actually started trading, keep a hold of those, because they have two very good helpful points. Firstly, you can claim a certain amount of those back as a pre-trade taxable expense. So when you do your first end of year tax return, some of your startup costs can actually be claimed as a taxable expense, which reduces the amount of tax you have to pay. There are a few exceptions. Training, for instance. Any training that you do before you start trading cannot be claimed as a taxable expense. The reason for that is not because the HMRC are awful, but because a load of students were trying to claim their degrees as a taxable cost. The HMRC have tightened up a lot of rules recently. I'm afraid it's because people were taking the mick. So students were finishing their degree and having spent however many hundreds of thousands of pounds you have to do for a degree. Set up my business as a graphic designer. My degree to become a graphic designer cost me that amount of money, so therefore I want that as a taxable benefit. And the HMRC, I think quite rightly, really went, no! There is absolutely no way that we're going to allow you to have £30,000 worth of money off. Tough. But once you are registered, any industry-specific training you do after that, you can actually claim back. But if you're buying equipment, if you have paid to have a website set up, printed business cards, any travel that you've done around the place, you can claim that as a pre-start expense if you document it properly. Yes?
So when I would register like earlier as being a student, would I then?
No. If you try to do any part of your degree, the HMRC are going to go no, I'm afraid, even though you've already registered. They're very picky, but you know, the whole idea is that they have to make money. I mean, the tax office is a profit-making industry because they have to make money to be able to make sure that lovely roadworks that are going down the road there work.
But that includes MBA? 10 years after my business into MBA.
I think you'd have a tough time. Qualifications like that are difficult. Professional qualifications or membership of professional bodies, so if you join a trade association or anything like that, they can be claimed as a taxable expense. But your continual professional development, like master's degrees, etc., might be a difficult one to convince them of. It's worth a punt. Phone them up and say, I need to, I'm going to lecture at Oxford Brookes University. I need my MBA to be able to do that. I can't actually do my job without that. Therefore, surely that is an industry-specific critical expense. Can I claim it? The worst thing they can ever do is say no. Because they're not unreasonable. Trust me, they're not unreasonable. And it's always worth phoning them up and saying, I'm not sure about this, what do you reckon? And they'll go, okay, yeah, fine. Or they'll go, nah. In which case, you know where you are and you know what you can claim. And they are quite unambiguous about stuff like that. They're not going to muck about. So keep your pre-trade expenses. Keep receipts, keep records, please. Non-business receipts and payments. Basically, you will have a business account. If you set up any form of limited company, you are required to have a business account. And you might want to use your business account to buy a sandwich at the shop at lunchtime. And that's absolutely fine. You're allowed to do that. It's your business, your money. But you will need to keep a record of that because it's money out of your business account that you need to account for. So anything, even if it's kind of like non-business specific payments, keep those. And certain of those you can claim back as a taxable expense, but we're going to cover that a little bit later on. Money owed to the business, invoiced but not yet received. So some of you guys might find that when you go for funding, particularly if you're doing funding with local councils, you do the work and then they pay you. I'm afraid that's the way it works. So they will say, okay, certain number of outputs at the end of the month, you demonstrate those and then we will pay you. So it could be that you're putting an invoice in and you're getting paid 30, 60, sometimes 90 days later. Tesco, for instance, 120-day payment terms, by the way. So you do work for Tesco and they pay you 4 months later. So that's one thing when it comes to cash flow you're going to have to consider, but that needs to be evidenced for your purposes, but also for the HMRC. Also, any money that you owe that you haven't paid yet, you may have an agreement with a supplier that you buy a load of stuff and settle at the end of the month, like a bar tab. I'm not sure the HMRC can let you claim that one though. But keep a record of those as well, because if the HMRC audit you, they want to see everything that's going on, and also you need to know what's going on so you're paying on time and getting paid on time. And this is my favourite one. It goes back to what you said on that previous slide about so you remember stuff, so you don't forget. Many small business owners remember the above without needing formal records. It's all up here, mate. Don't worry, it's fine. If the HMRC ever audit you and you say, it's all up here, son, don't worry, it's fine, they will just laugh and fine you. So write it down, because actually 6 years worth of records is not going to stay up. There reminds me, who's seen the film The Mummy? Oh, if you haven't, it's a brilliant film. And he's got this map that gets burned, and he goes, "Don't worry, I'm the map." And the girl goes, "That's comforting." It's a bit like that, really. He does get them where he needs to be. But write it down, document it, and you have to have backups. The HMRC want originals, and they want backups. And backups these days can be scanned onto a Dropbox or Google Drive, or wherever you want to go it. The reason is they want to see the originals, but what happens if the originals are destroyed? So you got all your lovely invoices printed out in a folder, there's a flood and they're all mush. And the HMRC audit you and you go, "Oh, there was a flood and it was dreadful." And the HMRC will go, "Well, that's dreadful. Where's your backup?" And if your backup was in the same filing cabinet as the originals, or you haven't got one, they will just fine you. So make sure you double everything up, particularly if you're buying lots of stuff from shops. Because how many of us have gone into our wallets or our handbags 3 or 4 months down the line, and instead of a receipt, we have a blank piece of paper? Because the ink on cash receipts, they fade very quickly, and you have to keep them for 6 years. So if the HMRC open a box and see a load of blank receipts, they go, "Oh, they faded." Because they're not stupid. They know that's happened. They go, "Where's your backup?" In which case, stick them all under a scanner, scan them, record them, store them somewhere else so you can draw that back. But you do need to keep that backup. But the great thing these days is they don't have to be physical. You can actually scan and store. Whereas 5, 10, 15 years ago, really before technology caught up with the HMRC, they insisted on having duplicate physical copies as well.
So they want to see your records, do they want you to print them and send it to them?
No, they will come to your house, knock on your door.
They'll just say,
Yeah, and they used to like things printed off, but they're a little bit more electronic friendly now. So provided you can demonstrate properly that you've got that, then you're fine.
online.
Yeah.
The receipts,
So here we go. Here it is. There's a computer grab, and there's a spreadsheet. Away you go. If they ask you to print them out, don't argue. Yeah, yeah.
There's no backup because I'm doing it online.
You're doing anyway. So I would then, just in case that server goes kablooey, I would keep copies somewhere else. So if you get emails, have a separate file to keep the emails on, just in case they get lost, or have them at least backed up somewhere. So you're taking, you're doing a monthly backup. So you have an external hard drive that you just download all the important stuff on and keep to one side.
That's in Google Drive.
Yep, Google Drive, Dropbox. I mean, there's tons of places like that. Oh, it is in Google Drive. Yeah, Google Drive's great.
Yeah, but that is it.
Reasonably. Oh, so everything is in Google Drive. You might want to just make sure you've got it somewhere else, just in case. I know Google Drive is very unlikely ever to go kablooey, to be honest with you, because it is Google. But just for your own peace of mind, I would have it somewhere else, just in case one day Google does blow up. It's like the IT crowd. You ever watched that? The guys gave Jennifer, was it, their boss, a box called the Internet. This is the Internet. She went to a meeting with all of it, said this is the Internet, and they dropped it, and everyone went mad. It might go one day. You never know. But it's keeping copies, but electronic copies are allowed as a backup now. If everything's electronically transacted, it's pretty secure anyway, but might be an idea just to keep an extra additional copy somewhere else, even if it's in another Google Drive account. I don't know, but that's what they insist on. Okay, so how do you do this? There are a number of ways you can do it, and they're all relatively simple to get your head around. This is a typical cash book. This is for cash sales, where people are transacting with money straight away. So you go to some of your provider service and they pay you. So the date that you saw the customer, who the customer was, how much they gave you, was it cash, was it cheque, was it credit card, and how much you put in the bank. Now obviously if it's a credit card or a cheque, all of that money is going to go into the bank, but it could be that someone pays you £100 and on the way back from that particular business trip you put 30 quid in the car for petrol. So £70 goes into the bank of that, but you've also got a record that £30 went in the car. So that £100 is still accounted for and can be balanced. Okay, so that's a very simple way of doing it, and you can do that in a cash book that you can buy from a shop, or you could just get a piece of A4 paper or a spreadsheet and do it that way. So that is just for cash payments. You've also got the opposite. This is when you have to pay something out. The date, who you bought it from, how much, cash, cheque, credit card. So that's just a record of the money that's gone out of the business. And then this is for those of you who are going to be doing invoices. So you're going to be doing work and then supplying an invoice for payment further down the line. The date you sent the invoice out, because that's when the clock starts ticking. If you're on 30-day terms with them, if your date was, what's the date today? It's the 17th, isn't it? If your date was the 17th of January, you know you need to start chasing that now. Invoice number. Invoice numbers, keep them numerical. You know, start with 1 and go up. Some people do actually send their first invoice out as 153. So it suggests they've already had 152 customers to give them a little bit of oomph. It's up to you, but what you want to do is to make sure that whichever invoice number you have is one that's easy to trace, easy to follow. So if you are challenged by a client or by the HMRC, it's easy for you to find and engage with. And some people use the initials of their clients to personalise the invoice number, but make sure you've got some kind of coherent scheme for your invoice numbers, and I would keep them as far as possible numerical, because then it's just easier for you to get that in your head and get it down on a piece of paper. Just makes that much more sense. Who the customer was, the net value, the value that you charged them, if you are VAT registered, what the VAT amount is, and the gross is your net plus your VAT. We're going to talk about VAT a little bit later on. It gives me an opportunity to do my famous Jaffa Cake example of the madness of VAT. The gross is the combination of net and VAT, and then when they paid you, when that box is filled, they've paid you. If it isn't, you need to chase them. And whether they paid cash check or BACS transfer or direct debit, whatever it might be. These are all very simple ways of keeping a record of the money that's going in and the money that's going out. And you don't really have to do very much more than that. As long as it's coherent, well organised, you understand it, someone else can understand it. It can be that simple.
At the end of the year tax return,
Yes.
if you haven't got the money yet, say you did it if it was April to March, and you did the service, say, in March.
And you're getting paid in May.
Yeah.
May would go into the following years, because that is when the money lands in your
That's
account.
what I'm asking, you just go
Yeah.
and buy the money. Then.
You go by your actual turnover, not
You
promised.
mentioned about...
That's simply for traceability. They're not going to insist on you. If you've got a £5,000 contract that's landing in, actually the cash is landing in May, they're not going to ask you to pay that tax in April, but they do want to see what the business is doing and what it's turning over. So it's just good practice to have that available to them. No, they're not going to ask you to settle on it because it hasn't actually arrived. But I promised you Michael's two-shoebox method of accounting, and we'll do this, and then we'll have a little break out, because I know you like to have like 5-10 minutes to freshen up, and I must say, considering that we are talking tax, I think, next. Oh no, cash flow next. That's quite fun, actually. And I want to spend a good 20 minutes, if I can, on cash flow, because that is important to get your head around. But Michael's two-shoebox method of accounting. Now, this is not a recommendation of how you should keep your accounts, but an illustration of how simple it can be. And I am a massive advocate, as I think I probably said 2 weeks ago, of the acronym KISS, which is keep it simple, stupid. You don't want your business to be any more complicated than it needs to be. I worked with a lovely guy called Richard around about 4 years ago. He'd been unemployed for a very long time, but he was an electronics genius, and he could fix anything. And his business was buying broken digital cameras, fixing them, and selling them on eBay. Really nice, simple process. And apparently only 3 things ever go wrong with digital cameras. 2 you can fix. 1, you got parts for the other 2. So he'd buy them from auction houses and stuff really cheap and sell them for 60 quid, 70 quid on eBay. And I worked with him for about 4 months, and he came to me one week and he said, "Oh God, Mike, I tell you, it's a nightmare. I'm spending about 90 minutes a day on paperwork." And I went, "What? You fix cameras and you sell them an hour and a half?" And I'm good at Excel. I'm really good at Excel. But 2 weeks later, when I asked him to bring his Excel spreadsheet to me, this was a work of Excel genius. It was 12 pages of macros, of filters, of all this beautiful stuff that dovetailed into what was ultimately 80% useless. And I saw his little heart break as I went, what? No? And I took pages, and we got 2 pages that took him 15 minutes, freeing up an hour and a quarter a day to fix cameras. He could fix about 1.5 cameras in an hour and a quarter. That is an extra 7.5 cameras a week at 60 quid a pop. Suddenly his business is an awful lot more profitable. However, the problem with him is he assumed that because he was in business now, it had to be complicated. I'm a businessman now, it's got to be complicated. No, never make your business any more complicated than it needs to be. Keep it simple. If you've got lots of working parts within your business, obviously that is going to mean that there's going to be a higher level of complexity. Now, a hairdresser is going to find it easier to run a business than, I don't know, an architect, because there's so much more involved in that. But never make it more complicated than it needs to be. Money in, money out, what's left? And allow me to illustrate. Michael's two shoebox method of accounting. Funny enough, you need two shoeboxes, an A4 pad, and a triplicate receipt book that you can buy for about £10 at Ryman's or Staples or whatever they are now these days. Now, the first thing you do is to get your shoebox number 1 and you write the word sales on it, okay? And then you get shoebox number 2 and you write the word costs on it. And then you get your A4 pad and you do this with it. And at the top, you write the word sales. And there, you write the word costs. Now, I'm a gardener, this is my business, and I go and see Mr. Jones and I mow his lawn for him, and I'm going to charge Mr. Jones 30 quid for mowing his lawn. I've got my triplicate receipt book, so they're numerical, so for argument's sake, mine starts at 1 and goes through to 999. I do my work for Mr. Jones, he gives me his £30, and I write on my receipt book, Mr. Jones, lawn, received with thanks, 30 quid. Mr. Jones gets the top copy, and copy number 1 gets put in the front of my shoebox. And then entry number 1 goes there. Mr. J, £30 lawn. Okay? So receipt number 1 is at the front of my box. Entry number 1 is at the top of my list. I give him the top copy, the second copy goes in my box, the third copy stays in my little receipt book as my backup and is in the glove compartment. There we go, my backup is safe and secure away from everything else. Then I go to Mrs. Miggins and she wants me to clear out a gutter for her. And I charge Mrs. Miggins 25 quid for that. I give her receipt number 2. My copy of number 2 goes behind copy number 1 in my shoebox and under entry number 1 in my book. So we got Miss M, and it was £25, and that was a gutter, so I know what's going on. And then finally for that day, I go to Miss Pearce and I plant a load of bedding plants for her and I charge her £45. I give her the top copy of receipt number 3. Receipt number 3 goes behind receipt number 2 in the sales box. Entry number 3 goes below entry number 2 in the sales column. And we've got 3, Miss P, £45, plants. And I've got to spend some money as well. So I need some new lawnmower blades. So I go to a lawnmower shop and I buy lawnmower blades for £10. They give me a receipt. In the top left-hand corner of that receipt, I write the number 1. Receipt number 1 goes in the front of my costs box. Entry number 1 goes here, blades, £10. Then I need to buy some gloves because Mrs. Miggins' gut is disgusting. No way I'm shifting that with my bare hands. So I go to a glove shop and I buy a pair of gloves for £8. They give me a receipt. In the top left-hand corner of the receipt, I write the number 2. Receipt number 2 goes behind receipt number 1 in my costs box. 2. We've got gloves, £12. And finally, my bedding plants cost £18. I get a receipt from the bedding plant company. At the top left-hand corner of the receipt, I write the number 3. It goes behind receipt number 2 in the box and below entry number 2 in the book. Plants. For, was it £18? So what I've got now is, very simply, 30, 25 is 55 and 45 is 100. And 10 and 12 is 22 and 18 is 40. I take that away from that. 60 quid is my profit and that's how much I pay tax on, essentially. Now, if I'm audited by the HMRC, do I have a sufficient and accurate record-keeping system? Let's put that to the test.
Excuse me, what about the petrol? What about your...
Don't worry, we'll talk about petrol later on.
Okay, because it's part of the cost.
It is, and that's kept in a separate diary, and we'll talk about petrol as a separate thing when we talk costs later on. Okay, basic example, but yes, costs, diary, don't worry, we're covering that. Now, if the HMRC ever audit me, what they can do is they can open up sales box number 1. At the front is receipt number 1, which they can equate to entry number 1, and then behind it is number 2. Number 2, 3, 3, 4, 50, 900, 3 million. If they want to know how much I've spent, the same kind of thing applies. What I've got is a logical, accurate representation of my income versus my expenditure, and I can then say how much is left, hopefully. That is a sufficient and accurate record-keeping system. Not one I would recommend you to use, However, one of my clients, Tammy, who is a beauty therapist, you have to be careful. I really got beaten up at course once. I'd spent about an hour calling the girls in the room beauticians. And at the coffee break, someone came up to me and said, look, if you call them beauticians again, they are going to kill you. And I went, why? I said, no, beauticians can be trained in 3 months. Beauty therapists take 3 years. These are beauty therapists. And I went, okay. So just be sure I call everyone a beauty therapist now. You don't want to be beaten up. I'm going to end up with makeup and a nice hairdo. But she's a beauty therapist. And what she has got is an A4 folder with 12 of those plastic wallets in it, and each of those plastic wallets is a bit of card. And on those cards are April, May, June, July, August, September, October, November, December, blah, blah, through to March. And what she does is when she's, we're February now, so she does any work in February, the February sheet, any money she makes, any cash she earns, she gives the customer a receipt, and her copy of the receipt goes in the front of the piece of card, and the customer is written on it. So receipt number, whatever it is, Mrs. Thing on the top. Every time she buys something, the receipt then goes in the back of the piece of card, and she writes on the back of the piece of card what she spent. So for February, the front of the card is all the money she's made with the receipts. On the back of the card is all the money she spent with the receipts. If the HMRC ever audits her, she can go, there you go, and February, March, April, May, June, July, very simply, money in, money out, what's left? The second she lifts that thing upside down, and all the receipts fall out, she really is stuffed. But technically, the HMRC would never have a problem with that. They would go, you really need to think about getting it online, but can you demonstrate money in, money out, what's left? Yes, you can. And that is a fundamental equation of business. Every business, regardless of what it is. My Lloyds Bank statement these days is called money in, money out, and it's balance rather than what's left. But that's how we equate things. Yeah.
So what is the best way to...
Whichever way you can do accurately and consistently. For me, if I was running my own business, I would have an Excel spreadsheet to keep all my details on.
Okay.
So,
But you still have to keep the receipts.
yeah, you do need to keep the receipts.
So how do you keep them? Where do you put them?
You put them securely in a folder. March is receipts, numbered.
Folder.
Yeah, whatever you want to do in a shoebox.
You have one receipt, it'd be A4, one receipt on an A4. How do you do it?
How would I do it?
Yeah.
Well, what I would do, you know, you can get if you get because
4, 4, 4, or the way we used to do it is just clip, you know, each one.
Clip them together,
A4.
yeah.
But it looks a bit.
Looks a bit messy, but is it accurate, and can it be accurately looked at? Can you actually hand that to someone and they understand what it's all about?
Yeah.
Because that's really the bottom line.
Yeah.
It doesn't matter how you keep your records, it's up to you. What you've got to be able to do is to hand them to someone else and for them to be able to understand it.
Is proven to be the
proven way is to keep accurate, engaging records. There is no there isn't something the HMRC is going to say, this is the way you have to do it. What they want you to be able to do is to say, this is all the money I've earned and the evidence. This is the money I've spent and the evidence. So I would have an Excel spreadsheet which had all of this stuff on rather than a piece of A4 paper. I would have my physical receipts in a concertina file with January, February, March, April, May, so they're all in there, numbered, so they can be equated to what's on my spreadsheet nice and easily. That's numbering's great. Receipt number 1, entry number 1. Doesn't matter where it is. It could be file number 1 on a computer. Word document number 1 equates to entry number 1 if you want to keep them online. But what you have to be able to do is to say, here is the physical evidence, and here is what I'm saying I've earned, and the two have to meet all the way down the line, and evidence. So technically, is there a hard and fast best way of doing it? The HMRC would tell you to get a decent online package of some description, such as Sage or QuickBooks. Free Agent is quite a good one as well. Sadly, it's not free. It's a bit of a misnomer, but Free Agent is recommended by quite a few of the banks as a really good virtual online system for keeping your records. So they would suggest having some kind of formal electronical way of doing it, because that way it's likely to be more accurate. However, 2 shoeboxes and an A4 pad, they may not like it, but they're not going to sue you for it if you can demonstrate accurately what you've earned and what you've spent. So really it's down to how you want to manage that business, the expectations of your customers to an extent as well, because that will drive some of your interactions. If you're business to business and you're providing a lot of invoices, those invoices will be emailed. You know, you will be sending PDFs or scanned documents and things like that, so that's how you choose to keep stuff. If you are a gardener, which is cash rich, that might be the way you want to do it. But the thing you've got to ask yourself is, if I ever handed this to someone else, could they accurately understand what I've done? If the answer to that is yes, it's a good system. So I cannot answer the question of what is the recommended way of keeping your books, because actually there isn't. The recommended thing is to accurately record what's in, what's out, what's left. Up to you how you do it. Personally, I would use some form of electronic package, whether that is an Excel spreadsheet or something like QuickBooks, etc. I do not endorse this kind of stuff. Too much can go wrong with that kind of system, like dropping a shoebox. The other thing as well about it is I was doing this course in Bedford a few years ago, and there's a lovely American lady on the course, and she said, look, it's all very well saying this, Michael, but how can I discipline myself to do it? I apologise to any Americans in the room, that was a dreadful accent. She said, how can I discipline myself to do it? And I went, by disciplining yourself to do it, perhaps. We were talking about, trying to think whether I do so many courses, they sometimes blur into each other, and I've forgotten what I've said. One of the things about researching your business is you then understand how much time everything's going to take. And what you want to do is just set aside time for accountancy. Now, if you are a retail business, you cash up at the end of every day. You know, so every day you're reconciling your books. You know, if you are a hairdresser, it might be that at the end of every week you sit down for an hour and reconcile your books. If you're a consultant who only does 10 hours of work a month for £1,000 an hour, then you know what, you can probably sit down for an hour at the end of the month and reconcile all your books. But what you have to do is to apportion time, because you always want your bookkeeping, you never want it to become a task. It's something that you do. As soon as it becomes something you go, oh God, you are going to make a mistake. And that's when things go belly up in terms of your relationship with the tax office, but also potentially your business not working properly. My singing teacher, for instance, is very, very good with his books, but he's recently moved to France. It's cheaper for him to live in France and commute to Milton Keynes to teach people singing than actually live in England, which is a bit sad. But he was saying that because of all this move to France, he spent 3 months, he suddenly realised I haven't done my books for 3 months. And he was doing an adjudication in London, and in the big emphasised bed of the hotel he was staying in for that night, he said until 3 o'clock in the morning he had all of the bits and pieces over the bed, and he was stapling them all together and putting them in the right kind of format. And he said, you know what, I think by the end of it that was right. My concern is that the word think is in there somewhere. You don't want to think, you want to know. So make sure that you assess your business and apportion the right amount of time to make sure that this isn't ever something that becomes a task. It's just part of your daily routine. If you can get that sorted, you're going to hopefully maintain your accuracy. Yeah.
If you buy something and you do lose the receipt, but you know what that money has been spent on and you can account for it.
Keep it in a diary,
Yeah.
claim it, and then if the HMRC come back to you, say, look, I lost the receipt, this is the record I kept of that transaction. Now, I'm not guaranteeing that they'll let you off. It will depend very much on how much it was. If you spent £4,000 on something, going, oh, sorry, lost the receipt, they're probably going to go no. But, you know, they're not unreasonable people. I mean, one of the questions I get asked a lot is a lot of our clients at the minute are people who do crafts and arts. And a lot of them buy their stuff from car boot sales. And you can't get a receipt from a car boot sale. So what I say to them is take a notepad. When you buy something for a car boot sale for 20p, just write down what you bought and 20p. And then if the HMRC do ever say, so, look, I buy my stuff at car boot sales, I can't get receipts, but here is a list of the stuff I bought. And again, it's some form of evidence. You know, you send a burger van, you don't give receipts to everyone who buys a burger. But you know you started with 200 burgers at the beginning of the day and you only got 50 left at the end of the day, you've sold 150 burgers. Thank you very much, there's your evidence. So you just need to be demonstrating that you're trying to keep accurate records. They are not stupid, but at the same time, they have been doing this an awful lot longer than you have. So I had a lady on a course who went, yes, but seriously, Michael, if I get paid cash, do I have to tell the HMRC? Can't I just put it under the bed? Seriously, and I went, no, that's tax evasion, and that leads you to prison, by the way. Right, cash flow. Like I said right at the beginning, the most important and critical document your business will ever own. 80% of businesses fail because they run out of cash. I'll give you an example. Zavvi. Anyone remember Zavvi? They were Virgin Megastores, and Virgin sold Virgin Megastores to a company called Zavvi. They sold low-cost CDs, DVDs, computer games, etc. Zavvi, which was a high street brand, went bust pretty much overnight. Does anybody know why? And you're not allowed to say cash flow, because, yeah, that's cheating. Zavvi...
I can tell you.
Go on then.
They couldn't buy any more stuff to sell.
Why is that?
They don't have any money.
No, it wasn't that, actually, because they were a perfectly profitable business. They were making reasonable money. Unfortunately, they had made the critical business error of having only one supplier of all of their goods. And that one supplier, quite rightly, was Woolworths. So when Woolworths went bust, they took Zavvi with them, because Zavvi couldn't buy any stock. Without any stock, they couldn't pay staff, rent, etc. And as far as a high street presence was concerned, done. I believe you could still buy online from them, but high street was gone. It was brilliant. I was unemployed at the time. I was all of their closing down sales. My JSA was blown on most of that for a couple of weeks anyway. But cash flow, a profitable business can be crippled by poor cash decisions. There was a guy that came along to one of our courses. He used to run an IT business. He supplied and maintained IT equipment for businesses, and 70% of his income was provided by one client who paid every single month without fail. And that one client was bought out by an American company who had 90-day payment terms. So suddenly they had 3 months where 70% of their income was missing, and it buried the business, destroyed him. Happy end to that story, he was on our business course to set up a nice little social enterprise, funny enough, helping people with learning disabilities repair bicycles and sell them. And he says, much nicer than my old business, I'm having a great time now. But a profitable business, a very good business, suddenly the cash goes and it destroys it. I mean, it is, I'm not going to pretty this up. Now, red numbers kill businesses. If you've got a red number in your business that nothing can be done with, that's it, end of story, you're game over. It's not going to happen. So the cash flow is what will help you understand that before you actually start trading, but also the thing that helps you maintain that going forward. So it will start with your pre-start costs for you guys anyway. There'll be a column for those. The opening balance, so your opening cash position. Money out, what's left. You carry what's left forward to the following month and you start all over again. And it's real money in real time. It's money when it actually happens. If you pay something on a quarterly basis, it goes into a cash flow on a quarterly basis. And what I've got here, and hopefully you'll be able to see it reasonably clearly, is a cash flow. Now, don't worry too much about the numbers. It gives me something to point at more than anything. This is Celebration Cakes. This is a cake-making company. And what we've got here is that they've got 2 revenue streams. So you've got cakes to trade and Celebration Cakes. Cakes to trade are people they're providing, like cafes and shops and places like that. They're being paid on a 60-day invoice for that. So they make their cakes in January and they get paid in March. That's the way it works if you're business to business sometimes. Celebration cakes are wedding cakes, Easter cakes, birthday cakes. You bake the cake, you give them the cash straight away. That's a great thing about retail. There's no hanging around, you just get the cash. So they've got 2 cash lines. One where they're being paid 2 months in arrears, and one where they're being paid straight away. Now, let's go back to the beginning here. Pre-start, they put £1,000 of their own money in to help. But all of their costs here, so we've got cake equipment, we've got travelling, we've got, where are we? Advertising promotions. All of their startup expenses go to £1,590, which means they start £590 in the red. £590 of money they haven't got straight away. Then, problem is that in January they're doing £635 worth of work. They've made £300 worth of cupcakes, but they're not getting paid for 2 months. So they're expecting, really, they do £600 worth of work, but they only get £300 worth of income because they're waiting for the rest of it to come in. So suddenly, none of their costs have changed, and we've got a position here where they're £1,119 in the red. We've also got here, same thing in February, expecting £600 to come in, or they've done £600 worth of work, not happening. £1,588 in the red. Things even out now because that money starts coming in, and then finally at the end of the year they've got £3,832 to the good. Now, long term, is that a viable business? Yes, it is, because next year that £3,832 is going to be much bigger because they've got rid of all this faff at the beginning. They've caught up with themselves and they can expand and do those kinds of things. So long term, that business has viability, and very few businesses start in profit. Most businesses start with some form of deficit. The easiest businesses to start up are mobile hairdressers. They're great. They come to us and we know they're going to trade because they've already got all their equipment. There's no startup costs, except maybe 40 or 50 quid on some business cards and a bit of fluff for the website. Other businesses start. I also work with University of Hearts, and there was a guy developing a product and he needed 60 grand to start his business up. So he's got a 60 grand deficit that he has to fill. But by doing this exercise, so you put all the money that you expect to go out, and that's quite easy, you can generally predict the costs out. And then you make a reasonable stab. You make an educated assumption about how much you can earn. And that comes down to, oh, what was those 3 words that we talked about? Research, research, research. You research your clients, you research your competitors. I'll have a little example of where you can play around with this bit at the top in a minute. But looking at that cash flow, I know that I can't start trading unless I can fill that £1,500 gap. So this is, I think I might have used this analogy 2 weeks ago. I say I do so many of these courses, I sometimes forget what I said where. It's about the diving board. Did I talk about the diving board with the cash flow? Oh, I didn't, okay. Has anybody ever dived off a 10-metre diving board? I have. Bloody terrifying. It's 30 feet up, and even the biggest pool looks really, really tiny. And I was in Frankfurt with an old girlfriend of mine. I dived off, landed awkwardly, and hurt myself in a place gentlemen don't really want to be hurt. Managed to sputter my way to the side to see my girlfriend laughing her head off at the top of the 10-metre board, and then coming down the stairs and not jumping off herself. Funnily enough, that relationship did not last very much longer. But that's what it is. If you're standing, this is your diving board, if you're standing at the edge of your cash flow and you're seeing a beautiful deep blue ocean of cash, you dive in. If you're seeing a little teacup with a splash of milk in the bottom, you take a bit of a step back and you rethink where this is going. Because you can make adjustments and amendments to try and improve your cash position. It's not set in stone. You might have grand plans that you might have to reduce. One of our ladies wanted to set up a Thai restaurant. Couldn't afford to set up a Thai restaurant, no chance. So she went mobile catering instead. The idea is that she could afford to do that, and actually she's still trading about 18 months later and doing good money. The idea is she starts with the mobile catering, she builds up a cash position, and ultimately she gets a Thai restaurant. So her first cash flow went no, but she amended it and said there was a sensible alternative. But what you don't want to do is to start trading without being able to do anything on this. So what do we do when we got red numbers? Where do we go? We might go to a bank. See, I do ask non-rhetorical questions most of the time. We'll talk about banks and what they expect from you later on, but a bank would look at that cash flow quite favourably. They will ask themselves 2 questions. Firstly, is it long-term viable? Yes. And also, is it high risk? Cakes. Are cakes a high-risk business? No. Everybody loves cake. We need cake. Cake is VAT-free, by the way, as well, but we'll talk about that in a second. So a bank would give, now what do you think is the best solution a bank could give on this cash flow? Overdraft. Yeah, not a loan. Loan is for long-term solutions. Overdraft is for short-term effect. So about a £3,000 overdraft would help this business out. Why I say £3,000 when there are only £1,588 in the red? Let me zoom into that and I'll illustrate what you have to do. If you're going for an overdraft, which some of you might have to do, you never know. I'm just going to hit, yeah, there we go, there. So what we got here is our worst cash position, which is April, as it happens, is £1,588. That means that at the beginning of May, we're starting with a deficit of £1,588. Now, when you're in business, you plan for the worst and hope for the best. The worst case scenario here is that all of your costs for April come out on the 1st, and all of your income arrives on the 2nd. If all of your costs come out on the 1st of April, that's your £936 costs for April. Actually, your bank balance is suddenly £2,500 in the red, not £1,588. And if you've only got a £1,500 overdraft, that's you stuffed. So if you're looking at overdrafts, always look at your worst position, and then just for contingency, you add on your costs for that month, and you pop an extra 20% on top for good measure. A £3,000 overdraft will see this business comfortably off. But if you have a red number in your cash flow that you can do nothing about, that business is finished. There is no way around that, I'm afraid. So that's why cash flow is so important. It gives you the opportunity to address those things before they happen. So from the planning stages, you can see what you need and approach a bank. And then once you're trading, at the end of every single month, you replace the forecasts with the actuals. And because you will be using a spreadsheet for this, I did have one client who did his cash flow in pencil once. And it was brilliant. It was absolutely accurate. Couldn't fault it. I said, well, what if something changes? That's a hell of a lot of rubbing out, isn't it? So there are these things. I'm sure they're actually on the Oxford Brooks website. I'm sure there's a cash flow. I remember from last year. And certainly on our website, you can get cash flows. If you put cash flow Excel spreadsheet into Google, you'll get thousands of responses. And they've all got the formula in the boxes. So you put the numbers in and the adding up's done for you, which is nice and easy. But you replace the actual and it recalculates all of these so you can see what the actual has done to your forecasts. And if those actuals have made the forecast look better, and you've got loads of cash, you pat yourself on the back and you can buy an extra pint at the end of the month. If you hit what you were expecting, congratulate yourself on good forecasting. Sadly, no extra pint. If you see these red numbers getting bigger, the thing is you're seeing it months in advance, which allows you to do something positive about it. Much as I hate any word you can do this with, it allows you to be proactive. Hate that word. When I started in management about 15 years ago, everything had to be proactive, to the point where it didn't really mean anything. You can make positive decisions about, I don't know, doing some extra marketing to try and get more interest. Take on a part-time job so you don't have to take so much money out of the business before, so you can manage some of the shortfall. Lay some staff off, or ultimately say, do you know what, I've given it a good shot, but it's probably best for me to stop now before I have to sell my house. Because sometimes businesses don't work, not because they weren't good ideas, but it was just not happening. It was not going to happen because the client wasn't there or the money was wrong. And it's actually better to stop in the positive than actually find yourself squandering yourself in the negative. I say a quick example. I'll give you a nice positive example, but a quick example of this is a guy, I did his cash flow with him. He was going to do a franchise and he was tinting car window screens. He was going to Honda garages and BMW garages and he'd tint the windscreens. And he was joining an existing well-established franchise, and at the end, when we did his cash flow, down here he was £25,000 in profit. Nice. Problem is though, month one, he had to buy into the franchise, do the training, which he had to pay for, and buy the equipment. Then he started trading in month two, and he was being paid on a 60-day invoice. So there was like 3 months where there was no income. And at the bottom of 3 months, here, the red number was 15 grand. And I said to him, do you have 15 grand? And he went, nope. And I said, is anybody going to give you 15 grand? Not a hope. Too big a risk for a bank to take. £15,000 deficit on the promise of a £20,000 profit. Not a chance. But think about it. If that guy hadn't gone through that exercise and had just started trading, lo and behold, in 3 months' time, he would have had £15,000 worth of debt. I never saw him again. He was coming for a grant for £1,000. Wasn't going to help. So it's very critical. But what I would encourage you to do when you put your cash flow together, and you will need to put a cash flow together, whether it's part of the program or not, you've got to put one of these blessed things together. I always put this stuff in first. You know, you need to know an idea of what you can make, but shove your costs in first. They're more predictable. And what it will tell you is how much the business costs every month. So if your business costs £1,000 a month, you know that you really have to make at least £1,100. Because a £100 profit is, manageable. It's not very good, but it's just about right. So if I'm a consultant who charges £100 an hour, I know that minimum I really need to be doing 11 hours work a month to make a £100 profit. And I can look at my research and go, actually, most of my clients, my research, I can get about 15 to 20 hours a week, a month. So I know that's viable, but I know I have to get 11 hours. Now, flip that to the same £1,000 and I make toy cars in the garage in my house. They cost me £5 to make and I sell them for a tenner. I'm making a £5 profit per car, which means I have to make and sell 220 cars every month just to make £100. Is that a business worth pursuing? It's not. Not a chance. So when you do your cash flow, concentrate on the costs, because you will need to be able to cover those costs. And you are part of that cost as well. One of the things you will need to do is a survival budget, and the survival budget is how much you cost the the business. How much do you need to take from the business to pay your bills, your rent, etc.? And your business needs to be profiting by at least that amount, otherwise it's not going to work. And there is no niceness about this. It either works or it doesn't, a cash flow. And if it doesn't work, go and tweak it and see what you can do to make changes on it, obviously sensible, realistic changes. But if this does not look right, don't take the plunge. Don't dive off. You'll hit the concrete, not the teacup. But if this looks really, really good, dive in, swim with it. Remember, I mean, we're doing this all the time. 100 businesses a month with an 87% success rate. 87 businesses every single month in Hearts and Beds have been set up. But every single one of them have done this, and that's why they're successful. The NEA program, which you did for the Job Centre, we delivered with the Job Centre up until end of last year. The reason that 87% of them are successful is not because we're brilliant. I mean, we are, but not just because we're brilliant, but because by going through a sensible process of planning their business, of researching it, of doing a cash flow, at the end of the 8 weeks we work with those people, they could be at the edge of that diving board and decide whether it was worth diving in or not. The reason we have an 87% success rate is because the people who do trade on the back of that 8-week course are trading on a good sound knowledge that they're likely to be successful. Whereas if you don't go through that process and just start trading, you're likely to fail. So our numbers are so high because, yes, we give good advice, but also because they've been through a process which will indicate to them very strongly whether it's actually worth trading. And that is it. Even for a social enterprise, you've got to be able to at least break even. If you can't do that, it really isn't worth it, because you're just going to let everyone down ultimately because you can't afford to help them. It's a horrible thing to have to do, particularly for an area you're very passionate about. We see it all the time. People are going into employment for themselves. They're very passionate about what they do. They have to be self-employed. I mean, you've got to have a certain passion for it because it's a very arduous thing. It's a great quote on LinkedIn. Richard Branson, I think it was. Entrepreneurs are the madmen who work 100 hours a week so they don't have to do 40 for someone else. If you reckon that starting your own enterprise means you can wake up at 10 o'clock in the morning and do 3 hours work and then go to bed, you're sadly deluding yourselves. And I know that this is going to fit in with your studies to an extent as well, and that's something you're going to have to take into consideration for scalability. So, cash flow, please, 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 get this right. And I'll give you a happy example before we finish. I worked with a lovely lady called Claire, and she was a nail technician, which is what you have to call a manicurist now. Because apparently you get beaten up if you call them manicurists, you know, beauty therapists, etc. She was buying into an existing beauty parlour, so she was actually renting a chair at an existing beauty salon, and she was going to do nails. And she was only going to do Monday to Friday 9 to 5 because she had kids, and treatments were 90 minutes a pop, so that's 2 in the morning, 2 in the afternoon, 4 a day at 30 quid average, so that's £120 a day, £600 a week, £2,400 a month. And in her cash flow, we put £2,400 at the top of here. She looked at the money she had at the end of the year and went, oh, hello, Florida, because she was rolling in it. But I said to her, Claire, do you think you can get 20 people in that seat every single week, all the time? And she went, no. Do you want to have to do 20 treatments every week? She said, no, I'd probably die. And I want some time to do my books and things like that. So what we did instead of calculating against 4 treatments a day, we calculated against 3 treatments a day. And we put that at the top and see what happened down here. And then we put 2 treatments a day and to see what happened with the cash flow. Eventually we got to the point that she needed to do 6 treatments a week, 24 treatments a month to break even. And I said, Claire, can you do that? And she said, I'm seeing more people than that in my front room at the moment, that'd be easy. But she went into a business with a firm foundation that 24 people a month was her break-even point. I have to get those people. Once I've got those 24, I can either do tons of more work to make a load of money, or I can stick my feet up. Claire is still trading. She is actually in the village just opposite me, a place called Amptill, and she's very busy and really happy. Because she hasn't quite got to a £2,400 a month, but she's not far off, which for a one-man band isn't bad going. So this is a lovely piece of kit. It's not particularly interesting, but the thing about numbers is they always do as they're told. You put the right numbers in the right boxes and you get the right results. Quickly on raising finances, because we've got 25 minutes left and I want to talk about tax. The 3 Fs. This is the highly technical financial terminology. I have my facetious voice on. The 3 F's stand for friends, family and fools. These are the 3 people that you go to initially to help you out with your business. It could be that Auntie Madge is a bookkeeper, in which case, you know what, Auntie Madge can sit down and tell you how to keep your books properly. It could be that Cousin Henry is a web designer and he can do your web design for you. You know, your sister's a graphic designer and she can do your logo. Draw on the people around you to see whether there's anyone who can do it for free or for mates rates, because that does help the cash flow. One chap, his mum, he was 21, he lived at home running a gardening business, and mum said, you know what, for the first 12 months of your business I'm not going to charge you rent. Mum hadn't given him any money, but he was paying £240 a month in rent. Suddenly he had £240 more in his cash flow to play with, which was helping his business. They can give you cash as well. Worked with a guy called Alfie, and Alfie sold vinyl on eBay, and he needed £1,000 to buy a load of vinyl, and he didn't have £1,000, so he went to the Royal Bank of Mum. Mum gave him £1,000. Alfie loved his mum. I'm sure she got a return on her investment. I'd imagine, I don't know what funding or help you can get, but the university, if they don't have money, I'm sure will have contacts and ways to assist you in this. So, you know, speak to Jeff, speak to the guys who are kind of in charge of this whole scheme to see what they might be able to do to help you. Kickstart appeals. Kickstarters, crowdfunding, online appeals, great for social enterprises, charities, etc. This is where you say, I need 10 grand. So what I want is for the general public to pledge money to my cause. And if you reach your £10,000, you get to keep it. The thing is, generally people pledge because they want something back. Now for a social enterprise, that might be a mention, it might be a t-shirt. You're going to have something to sweeten the deal. But Kickstarters are a very good way, crowdfunding, democratic funding. But have a look for Kickstarters. They're very good for particularly arts and crafts, and the kind of enterprises that have got a worthy cause, because you want to get the public on your side, and it's actually the public that fund you. And there might be a little bit of a return that you need to do, but it's manageable. Lots of people have used Kickstarters these days. Kickstarter is actually the main website that started it all off, but put Kickstarter websites or crowdfunding into Google and check them out. There are quite a few. I did a course on it a few months ago. Grants might well be available. I can't tell you what's available in Oxford. I'm afraid Oxford is off my patch. But there are some grants available in Herts and Beds. Stevenage Borough Council and Luton Borough Council do grants, which is money they give you to keep. I'm not sure whether the Prince's Trust might be something that you guys, certainly if you're under 30, which I'm sure is everyone in the room, the Prince's Trust is a good place to talk to. And old Business Link may not be still there as a big business advice portal, but a business advice company, but they do have some online services, and one of those is a grant finder. So it might be an idea to search the internet for grant finders, particularly as you've got social elements to your businesses. And the CVS, the Community Voluntary Services, may well be able to help you with things like lottery grants as well. So do check them out. Banks we've talked about. If you want money from a bank, they will want 2 things from you. They will want a business plan and a cash flow forecast that demonstrates your capability to pay them back. They will not give you any money unless you have those 2 things. Also, they will also ask for matched funding. If you're a startup enterprise like you guys are and you want 5 grand from the bank, they will want you to demonstrate that you either have 5 grand or you've got 5 grand already invested into the business, which is why you keep records of all your startup costs, because that's evidence of investment. And lenders of last resort. I'm not sure necessarily whether this is, and don't please think that's a guy called Kevin around the back of a pub with a bag of cash and a baseball bat. Lenders of last resort are organisations which will lend money to people who have been declined by banks. Now, I don't know whether they cover this area, but there's one called Foundation East, which we use a lot in our area. They are a social enterprise that was actually born out of Suffolk County Council. And they will lend money to businesses that have been declined by a bank, so you have to take your statement saying the bank's not going to lend to you. They don't do credit checks. They will require a business plan and cash flow forecast, and they will charge around about 25% interest, because they're taking a massive risk. The great thing about Foundation East, though, is that because they're a social enterprise, they just need a return on their investment. So if you ever get to the point where a bank is prepared to give you cash, they'll sell the debt onto the bank with no further charges to you, which hopefully means you get a more competitive rate. But we put last resort in there for a reason. So lenders of last resort are the last resort, but they will require, all of these guys, grants, banks, Kickstarters, etc., will require business plans and cash flow forecasts before they do anything for you. Okay, VAT registration. Social enterprises will still have to be VAT registered. They are treated exactly the same as limited companies. Charities, I believe, are VAT exempt. Don't do an awful lot with charities, so I don't know a huge amount about those. But VAT is very, very simple in execution and complicated and stupid across all the other bits and pieces. Essentially, let's go back to my guy who sells a toy car. I sell my toy car for £10. When I'm VAT registered, I then have to add 20% to the price of that car. So my car now is sold for £12. So I sell that car for £12, £10 goes into my bank, just like it always has done, and £2 I give to the VAT man. Essentially, VAT is a tax that you collect on the VAT's behalf. It's not a tax on you, it's a tax on your customer. You collect it and give it to them. So whatever you charge in VAT, you give it to the VAT man, and if you're VAT registered, if people charge you VAT, you can then have it back. The VAT man makes no money from business to business or tax VAT registered companies because they just claim it back, charge it, claim it, charge it, claim it. It makes money from people like us who are not VAT registered. Because if I buy that car for £12, that's £12 has gone. I can't claim it back. So compulsory VAT registration, £81,000 worth of turnover. So as soon as in any 12-month period you hit £81,000, you have 30 days to VAT register, otherwise they start fining you. And the VAT office, though they are very helpful, do not mess about. They will have you. The VAT man are very scary. They have greater powers than the police. If you owe them money, they can come to your place of work, which in some cases might be your home, and they can remove stuff from that property without warrant or warning to the value of the money you owe them. Sofa, fridge, kids are about £1,500 a piece. Those of you who have them, choose which one you love the most. But, joking. But that is very important to get right if you do take it on, so get advice. Because it is slightly bonkers. Cake, like I said before, is VAT-free. The famous Jaffa cake example. Jaffa cakes are VAT-free because they're a cake. But the VAT office went, no, they're a biscuit. Because biscuits have VAT charged on them. You see, there is luxuries and there's staples. Cake is a staple, biscuits are a luxury. So, it's free. So the VAT office went, no, Jaffa cakes, I'm afraid it's a biscuit. And McVitie's went, it's a Jaffa cake, duh. And it went to the European Court of Law, and what it boiled down to were the properties of cake versus biscuit. If you bake a biscuit and you leave it on a shelf, it goes soft. If you bake a cake and leave it on a shelf, it goes hard. McVitie's cooked a Jaffa cake this big and left it on a shelf. Sponge base goes hard, therefore cake, therefore not vatable.
But why is cake VAT-free? It's a staple.
It's a staple. I don't know why. It makes, because actually biscuits were developed for very practical terms because they went to sea. They were sea biscuits. That's what, but cake? No, let them eat cake. No, for some reason cake is one of those staples. It's weird. Gingerbread man. A gingerbread man is VAT-free because it's gingerbread. And if you've got 2 chocolate eyes and a chocolate smile, it's VAT-free. But add 3 Smarties for buttons, it tips it over the chocolate threshold, and suddenly that gingerbread man is vatable. Don't get me started on pasty tax, because as a Devonshireman, that's an affront on everything West Country. So the thing about VAT and execution is very easy. You charge it and give it to them. Someone charges you, they give it back. Nice. Unfortunately, there are so many different shades of grey. There are more than 50 shades of grey, I'm afraid, within the tax service. You have to remember that one there. That's topical. Oh my goodness. It's a bit bonkers. So get a lot of help with VAT, because if it goes wrong big time. And I'll passing shot on VAT. In my early days with WENTA, I went on a HMRC seminar, which consisted of my 2 least favourite things: tax and networking. I hate networking. I could deliver this course to 20,000 people, wouldn't bat an eyelid. I can't go, hello, Michael. Can't do that, I hate it. Half an hour of tax, half an hour of networking throughout the whole day. And the very last one was VAT. And about 10 minutes into a really dull presentation, one of the guys in the audience went, whoa, hold it a minute. So the way I deal with VAT for petrol is different than the way I do it for the HMRC? And the VAT man, and this is no word of a lie, he put his hands on the table like this, looked the guy dead in the eyes and went, oh yeah, don't expect any logic from the VAT man, and then carried on with his presentation. He was going, I'm sorry, it's VAT, it's bonkers, get used to it. So if VAT does rear its ugly head for you, which depending on the kind of funding streams you get might well happen, make sure you take it seriously, get some help and do it right. Yes, you can keep your own VAT records, but at the same time you want to make sure you don't get caught out. Right, quickly on tax. This is the current thresholds for income tax. I thought, yeah, I found the Monopoly one. I thought that was quite a nice image there. I wish it was £200. This is your threshold. You are allowed to earn, or your business is allowed to earn £10,000 worth of profit before it has to pay any tax at all on income tax. So this is free. That's tax avoidance in some respects. So you can avoid paying tax on the first £10,000 of your business's income. That is a personal allowance. You can't, if you've got 3 different income streams, you can't claim 3 different personal allowances. It's for you. But £10,000 is tax-free. So if your business doesn't profit in tax by more than 10 grand, you're not paying income tax on it.
If you're working somewhere else though, and not paying yourself, then...
Yeah, it is still taken. For instance, my wife was self-employed childminder and a teacher. She earned £15,000 as a teacher on the 3 days she was doing. Had to pay full tax on her self-employed business because she'd already exceeded a threshold. And then you got 20% between 10,000 and 41,865. So you're basically being taxed on £31,865 there. Yeah, and then. This is always free, this is always 20%, that bracket then goes up to 40%, and if you're lucky enough to get £150,000, you get 45%. But it doesn't, I used to think that if I got into this bracket, I was charged 45% on everything. But no, that is always free, that's always 20%, that's always 40%. Okay, so this is income tax, this is what's paid, probably the previous slide, sorry, is what you pay on the money that you earn. National insurance, there is Class 1 national insurance, which is charged on your salary. So if you pay yourself a salary, you will be paying income tax and you'll be paying national insurance. And you get £7,956 of that for nothing. So that's your tax threshold there. But your business, your social enterprises, will also be charged 13.8% employers' national insurance, which is your company's contribution to your staff's national insurance. So if you choose to take no money from your business, in income, you won't actually make any national insurance contributions. But your business pays 13.8%, so it's actually your business is then contributing. And the way a lot of directors of limited companies avoid paying tax, which is endorsed by the HMRC, is they pay themselves annually no more than £7,956, which is about £600 a month, which means that they're below the income tax threshold and they are below the national insurance threshold. So they don't pay any tax, and then they are allowed to claim out of the profit once all the other tax is dealt with. They're allowed to take all of that profit if they want to as dividend payments to supplement their income. And it's a far more tax efficient way of running a business if you're turning over more than about £41,000. However, I don't know how dividends change as far as social enterprises are concerned, because you can't greedily take all of that money for yourself. A certain portion of it does have to be reinvested into the business, and that is one of the consequences of being a community interest company. You can't keep quite so much of the money for yourself. At the same time, funders will take you more seriously and you get a better chance of getting money out. I would do some research on that personally, but that is national insurance. Your company, though, your community interest company, will be required to pay 13.8% on any income exceeding £7,956.
When you're talking about all the dividends and everything, would a bookkeeper be able to work on that?
Bookkeeper or an accountant. There are actually dividend calculators on the internet these days that will help you calculate what you can take out. Because you can pay yourself dividends on a monthly basis now. You never used to be able to do that. But they've got to be calculated accurately, because obviously if you overpay yourself dividends, you then have to pay back some tax at the end of the year.
I was just thinking my own as a bookkeeper was just very basic stuff. But you're actually saying that...
I'm saying that that is probably something you'd want an accountant to look at. Just for business expenditure, just to give you the highlights, yes, travel. If you are driving around the place, the simplest way of doing it, there are 2 methodologies behind it. One is that you can claim everything, but you have to keep all of the records. And every year you get the value of the vehicle and all of the stuff you spent on the vehicle. Problem is that that vehicle depreciates every year. So every year you can claim less and less tax compared to the value of the vehicle, which is why a lot of companies use lease cars, because they change them every 2 years and they can get back up again. The other is to keep a mileage record. I went to Mrs. Miggins to clean her gutter. It was a 10-mile round trip, and you claimed 45p a mile. And all you need to do is to keep a diary of all of your business mileage, and then whatever that business mileage is, you divide by 0.45, and that's how much you can claim back as a taxable cost. It's nice and simple. That's the way I would recommend it. For instance, I drive a 14-year-old Vauxhall Zafira that caught fire around about 1.5 years ago, and it's done 178,000 miles, which is 2/3 of the way to the moon. If I use the depreciated method and try to depreciate the value of my vehicle, I wouldn't get very much tax relief. But 45p a mile, doesn't matter how old my car is. And the great thing is, anybody ride a bike? Cycle? Yeah? 20p a mile for your bicycle. If you ride a motorcycle, 26p. If you car share, you get 5p extra per mile for every employee in the vehicle with you. If you can prove that. How many people can get in a Mini. So, other things you can claim, or you can't claim actually, entertainment. So if you schmooze a client and you take them out, you can put that through the business costs, that's fine, but the HMRC don't allow you to claim it as a taxable cost. Subtle difference between business cost and taxable cost. Clothing, you can't claim unless it's a safety unit, or it's hard hats, steel toe cap boots, tabards for beauty therapists, or, I don't know, high visibility jackets, stuff like that. If you can prove it's uniform or it's for safety, you can claim it as a business expense. If you just fancy a nice pair of shoes to impress a client, you can put it through the business books by all means, but I'm afraid you can't claim that as a taxable expense. You can't, yeah, I like this one. If you want a subscription to a golf or a health club for networking, yeah, by all means you can charge that to your business, but the HMRC will go, nah mate, you're not having that. Because people try. Personal drawings. Now, this doesn't apply to you guys because you're not going to be self-employed, so ignore that entirely. That's for sole traders. This is the slide from a much bigger course. And the purchase of capital items. Capital items are equipment that are going to cost you generally £2,000 or more, that are going to last 2 years or more. Like a big piece of machinery, a vehicle, for instance. So you can't, if you buy a car for 10 grand, you can't reduce your tax bill by 10 grand. What you do is you put that vehicle into a separate part of the online tax return, and each year you get tax relief on the depreciated value of that particular piece of equipment. So you do get relief on it, but it doesn't actually go into your normal business expenditure. It's treated as a capital item. Let's have a look at this. This is social currency, because actually we've talked a lot about the currency in terms of your finances. But you guys are setting up social enterprises. There has got to be some kind of social currency behind that. Now, what are the areas, the key areas you're looking at, and the people you're trying to help out? You know, NEETs, for instance. SLAs and KPIs, anybody know what I'm talking about? Key performance indicators and service level agreements. If you do go and get funding from an external body, they will have key performance indicators and service level agreements of things you have to achieve. And have a look at your commercial versus social. And I'm just going to do this for a second, and this is the last slide. But this was actually the way WENTA's social versus commercial purpose was kind of delivered to me recently, and it's quite good. So here is a line. And that's your break-even line. And what we got within WENTA is we got our beacon. And our beacons are schools programs. We go into schools and we do enterprise training with schools, particularly vulnerable schools. We don't make very much money at that. So this is commercial and this is social. So what we got with our beacons actually is a lot of social purpose and very little commercial. We've also got the stuff that we do for the universities. We're working with 3 universities currently and are about to start working with BEDS University as well. Now, yes, we do get some commercial stuff from that, but also there is some social. So it's kind of like 50-50. And then we've also got our business centres. Now, our business centres offer low-cost office and workshop space for small businesses on 4-week leases. So there is a massive commercial impact on that, and only a tiny social one. And we've got My Incubator Ventures, which is our online business advice portal, which has been designed to be commercial and not very social. So what we can do is we can see whether we do actually break even, because it doesn't matter that we don't very much money here, and this is where our social purpose is, because we actually offset it by doing this. Our advisory services, our one-to-one advisory services, they are commercial, but they are mainly social. In fact, they're probably our massive loss leader. The education department I work for make a lot more money than our advisory services. So we've got a lot of social purpose, because 87% of our clients are still not unemployed within, a year. Bit of commercial, but mainly social, because really we make very little cash on that. So what you want to have a look at what you're setting up here, and have that social purpose. Don't ever lose sight of that. That's why you're blooming doing it, to be honest. That's why you're putting yourself through all of this, because you want to put something back into the world. So make sure that you understand what the social purpose is. The critical thing is you've got to be able to balance that social purpose with a commercial element that at least covers your costs. Social enterprises, ideally, they just want to break even, yet having a bit of cash at the end of the year is nice because you can reinvest it, do some nice stuff. But think, where is the social value? For WENTA, our social value is very much in this area here. This in our education, getting people out of unemployment to self-employment, helping young school people understand that there is more than the exams. There are, if they're not good at exams, they can set up businesses. We've got some fabulous 16-year-old entrepreneurs in our books who are making a ream of cash. It's lovely. Going to the universities because graduate unemployment is an issue, which is why we do these kinds of schemes and want to engage with universities. All of these things have got a massive amount of social purpose and actually are not massively commercial. And we balance that social purpose by having the commercial elements of our property department, which is very driven on creating surplus that can then be fed back into all these areas. And we've got my incubator ventures, which we're selling into places like Base Point and Regis and stuff like that. So there's a tiny purpose that supports our new entrepreneurs, but most of it is about getting it into libraries, councils and big businesses. All of this stuff here means that we are able to indulge ourselves here. And that means that even if these are not commercial, if these are failing in terms of, even if we're losing money on them, doesn't matter. We can still ensure that we can pay our advisors, pay our trainers, and make sure that the people we have put ourselves out to help, the people that we've been interested in, whoever that might be, vulnerable young adults, homeless, drug users, whatever it is, we're not going to let them down. We are going to say we're going to do this to help you out, and we're able to do it. And we have to be able to keep a mind on the commercial element here, because without it, we can't help anyone. But we recently nearly nudged ourselves into the too far commercial. We pulled ourselves back, but this property became a little bit too businessy and lost sight of what it was actually there to do. It was too much about making money, not enough about supporting the business. And we pulled that back because we're a social enterprise. And this is where our real value is. And that's where your real value is going to be. But the bottom line is, unless you've got an element of this, you're not going to be able to help anyone.
Did you say you had 3 businesses? Isn't there 3 businesses?
Well, there are 3 types of business that we do. There is advisory services, educational services, and property. Yeah. So one-to-one advice, training, and low-cost office space, which is the commercial element of what we do, which, they make £600,000 surplus every year. So that means even if you lose our £2 million contracts from the job centre, we can take a load of that money and we can still pay people to give free advice. Thank you guys, I hope you found it useful. I'm back in a month to do project management, which is much more fun than this one. So thank you very much, good luck, and I'll see you in a month. Thank you.